Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. Canadian cannabis extract industry is set to explode later on this year when the federal government legalizes concentrates and edibles. Demand for extracted products like vape pens and infused products are expected to be one of the biggest sellers. The report foresees extracts eventually accounting for half of Canada's market for cannabis. That would go along with what we generally see in every other market. And in fact, Canada right now is the anomaly within the extract market amongst any other market that's gone live. We've seen an increase in concentrates, and yet so far what we've seen in the limited rollout is a decrease, and that can only be attributed to a combination of maybe high prices and low quality. We haven't seen any other market go back to the black market in the volumes that they have in Canada, and so all I can surmise is that there's too high of prices with too low of quality. So hopefully later on this year, we'll see that reverse back if quality increases and or prices decrease. Vape pens are expected to lead the way with 20% of the extract sector, followed by edibles at 15%, beverages at 10%, and other categories at 5%. Cannabis extraction is a critical step in the production of value-added products such as cannabis oils, gel caps, vapable products, and cannabis-infused foods, topicals, and infused beverages. In the fourth quarter of 2018, Canada's medical and recreational markets were dominated by dried flower products, while extracts represented about 13% of gram equivalents sold. The low penetration can be attributed to the limited offering from extracts, but again, also probably because of the low quality and high prices. Assuming that quality can increase, that provides a white label opportunity. Some of the larger cultivators are doing extraction internally, and others are outsourcing some of the processes so that they can use internal resources and capital elsewhere. Canopy Growth, for example, inked a multi-year processing and extraction agreement with Hollyweed Manufacturing and Extracts. Right now, they're outsourcing extraction, but for the prize for extractors is to provide white label services. We see that in every other segment. Take, for example, pre-rolls. You're seeing Organigram rolling 40,000 pre-rolls a day, and that's not for the local market. Canadians aren't going to be able to consume that many pre-rolls, so it's probably for the international market and eventually for the white labeling. They'll be making them for other companies to slap on their brand and sell them, because 40,000 is a lot per day, but not nearly enough to cover the global demand, but plenty for additional companies that want to slap their name on it. So white labeling has been something that companies do. You're seeing that in the CBD market. There's going to be a lot of mom and pops who crash and burn, thinking that their brand is going to differentiate them from somebody else's product when all the CBD is probably coming from the same spot. Or at least this generic example, those brands aren't differentiated. There will be just a collapse. They won't be able to go anywhere because they're not able to set themselves apart. Whereas with these companies, able to have economies of scale and manufacture 40,000 joints per day or a 55-gallon drum of oil per hour is at a rate that most companies can't keep up with. So you're either going to have to white label a private label another company's product or find another product to make because you can't keep up. Confident Cannabis, a cannabis wholesale platform powered by verified lab data, raised $12 million in the Series A funding to accelerate growth and expand into new markets. The round was led by San Francisco-based Poseidon Asset Management, one of the leading cannabis-focused funds. This is important because Confident Cannabis provides lab testing services across all verticals in the cannabis supply chain. Washington State currently is only testing for THC percentages, not for pesticides, which is a huge detriment. We've probably had more voluntary recalls than any other state. There's a program called the OK program. It was implemented by a retailer called Uncle Ike's and has since kind of spun off. But essentially, the OK program will pull a random product and test it. And we've had some terrible results from a vape company that had Eagle 20, which is a herbicide, but when heated up turns into a carcinogen. So that's definitely not good for you. There was another test where 5 infused and 5 non-infused joints all came back with mold. And it's been interesting to see how some of these companies have been dealing with that, some not so well, some pointing the finger and the blame, and that doesn't work, we've seen. If you take ownership of it, regardless of whose fault it is, that's been the best outcome. But regardless, we've had a lot of recalls for a lot of reasons. You think that some of these companies are altruistic and in it for good purposes, but not all of them are. Margins are being squeezed. You can see that in the $40 retail ounces, but it doesn't make it right. And so testing holds that accountability and keeps people from making short-sighted financial decisions. So with this funding, Confident Cannabis plans to expand its wholesale platform beyond Oregon, hopefully to Washington. Investing in cannabis product quality now can avoid major headaches later. The ramifications of poor quality includes loss of revenue, loss of market share, product recalls, or worse, legal troubles. Manufacturers of other legal consumer goods, specifically food and drugs, do not have a choice when it comes to quality. The manufacturing of their products is regulated by the Food and Drug Administration. But even without the requirements of government entities, quality should be the top priority on every company's list. In California, for example, 20% of products failed laboratory analyst tests and therefore cannot be released for commercial sale, according to multiple news reports. New markets such as Massachusetts has the opportunity to instill quality on the outset. To avoid problems with product testing, companies can build it better from the start using 3 dimensions of quality that are commonplace in other verticals. There's current good manufacturing practices, cost of quality, and quality management systems. All pharmaceutical companies are required to follow current good manufacturing processes, which assures the identity, strength, quality, and purity of drug products by requiring that manufacturer of medication adequately controls manufacturing operations according to the FDA. Current good manufacturing processes include testing, but testing alone is not adequate to ensure quality, the agency says. Adhering to the good manufacturing processes, while not yet mandatory by any adult use legal state, it requires cannabis companies to invest capital in order to achieve these standards. This could be a hard sell to a startup company fighting to survive in a sea of growing cannabis giants. The good news is that an investment in quality standards now is more profitable over time. Examples of product recalls for non-compliance in the cannabis industry are ever present. The Denver Post reported that in 2017, 15 companies recalled cannabis products in Colorado. Since the state legalized adult use cannabis, dozens of companies have recalled hundreds of thousands of products because of contamination, usually from pesticides. There's also examples of lawsuits over contaminated cannabis products in Colorado. The cannabis industry will face increased risk of product recalls and product liability lawsuits as long as testing is the sole means by which product quality is determined. However, companies can ensure that their products face the lowest risk with an investment in good quality to avoid the much higher cost of poor quality. The most common method for asserting the cost of quality is through the prevention, appraisal, and failure framework. The prevention and appraisal and failure framework is straightforward. You put systems in place that increase the odds of high quality product and then measure how well those systems are working. Those 2 dimensions of good quality are more commonly referred to as quality assurance and quality control. The key is to take as many measures as possible to avoid external failures in the consumer's hands. These are exponentially costlier for companies to remedy than internal failures. The current good manufacturing process reduces internal and external failures by building quality into the product from the top down. While using current good manufacturing process standards, the manufacture of cannabis products results in higher product quality. These standards don't guarantee a positive customer experience or increased revenue. A high quality product needs to be supplemented by strong service and support to increase customer satisfaction. There needs to be a quality management system in place that can connect product quality and consumer satisfaction to ensure an amazing total experience while driving sustained revenue growth. The timing of a company implementing a quality management system is extremely important. In a case study using a panel of 800 firms in Europe, the author noted that in 2011, the firm defined as late implements of quality management services experienced no performance gains, and their average performance level was no higher than that of their control sample compared to firms that implemented a quality management system from the beginning and experienced major gains. Overhauling organizational idiosyncrasies to retrofit a quality management system is more difficult as time passes. Cannabis manufacturers concerned with failing laboratory tests for non-compliance need to build quality into their product from the beginning, specifically using the mutually reinforced guidelines from the current good manufacturing process, quality control, and quality management systems frameworks. The combination of the three frameworks can be tailored to meet the needs of any cannabis manufacturer. The requirements were established to be flexible so that each manufacturer can decide individually how to best implement the necessary controls, allowing companies to use modern technologies and innovative approaches to achieve a higher quality through continual improvement. Continual improvement aligns with the objectives of the quality management system. Further, the companies who have a quality management system but don't use quality control concepts are less successful in reducing quality costs and improving quality for their customers compared to those who use both the quality management system and quality control in place, according to the research. If the argument of increased earnings and risk mitigation via these three quality frameworks is not convincing enough, consider this. What do tobacco companies, pharma, alcohol, and wellness all have in common? They don't rely on testing alone to ensure product quality. If the goal in cannabis is to get acquired by one of these large cap companies, then building manufacturing infrastructure with proven standards for vertical markets would be a strategic pathway to realize this objective. And if the goal is to not get acquired, but to thrive over time and eventually even compete with these companies, one need no look further than the FDA's approval of the CBD-based drug Epidiolex, a current good manufacturing practice requirement, have already entered the cannabis space. A wise investment in quality now will bring major brand value through product differentiation in an industry where products are becoming commodities. Quality always sets a brand apart, and this opportunity is ripe for the picking. Multi-state operators are not taking a break. In fact, I'm doing a podcast this week at the World Trade Center on multi-state operators. The capital infusion that we're seeing in Canada continues to come back down in the States and is expanding. As we're seeing Curaleaf expand into Ohio with a $20 million acquisition, the Massachusetts-based Curaleaf last week agreed to acquire Cura Partners for almost $1 billion. They'll expand into Ohio with the purchase of Ohio-grown therapies. The $20 million deal is expected to close in the second half of 2019 and includes the acquisition of Johnstown-based Ohio-grown therapies. They're a cultivation and processing facility. The $20 million deal, expected to close in the second half of 2019, includes the acquisition of Ohio-grown therapies, cultivation, and processing facilities and their licenses. The multi-state operator expansion can be seen in recent research from that of ArcView Research and BDS Analytics. They report that global spending on legal cannabis is expected to grow 230% to over $31 billion in 2022, compared to $9.5 billion last year. The research suggests that most of that, nearly $23.5 billion, will be spent in the U.S., with more states voting for legalization of marijuana and business interests sparking that definitely makes sense. BNY Mellon is getting involved in a new cannabis New York Stock Exchange fund. More evidence of the normalization and companies not wanting to wait. We recently saw that Bank of America started to report on the cannabis sector. Bank of New York Mellon isn't waiting for the States Act or the Safe Harbor Act. They're going to get on board just like BlackRock. So it all boils down to the fact that the normalization is occurring. People see the dollar signs, and they're not going to wait for federal legalization. Bank of New York Mellon will act as a custodian bank to a new cannabis-focused exchange-traded fund, or ETF. For the first time, a New York Stock Exchange marijuana-related fund is seen backing by a major bank. The advisor share pure cannabis ETF will trade under the ticker symbol YOLO. It will have 80% of its assets in companies that derive a minimum 50% of revenue from cannabis operations. At least 25% of the fund will be invested in pharmaceutical and biotech companies that work in the CBD and other cannabis sectors, while there will also be stock involved in non-plant touching segments such as real estate. Your weekly cannabis deal watch is led by cannabis retail and cultivation segments as they continue to lead the pack with regard to capital raises and acquisition activity. Year to date, the sector has raised a total of $3.2 billion and completed 48 M&A deals. That compares with $1.5 billion in 17 deals for the same period last year. In addition, the number of transactions involving private companies in 2019 as an overall percentage continues to grow, 27% so far this year versus just 11% in 2018. Top raises that closed last week include Green Lane Holdings, a distributor of vapes and other cannabis-related products, closed its NASDAQ IPO, raising $102 million in the process. Zenabis, a Vancouver, British Columbia-based cannabis cultivator, closed an equity offering of $28.7 million. And Village Farms International, Canadian greenhouse grower with a 50% stake in cannabis business Pure Sun Farms, closed a Canadian $20 million equity offering. Top merger and acquisition deals that closed last week include Acreage Holdings. They bought Portland-based Form Factory for $160 million. Cannabis One Holdings bought certain assets of privately owned Denver-based JBC Enterprise. And Canopy Growth closed its acquisition of Spanish cannabis cultivator, which cultivates marijuana and is licensed to produce hemp as well. As cannabis is legalized, it could replace alcoholic beverages on some drinking occasions, but also be used to formulate new beverages. At a time when cigarette smoking is on the decline, the report expects that U.S. tobacco companies will enter the U.S. cannabis market, but only if cannabis becomes federally legal. There are some companies that are already beginning to do that. For example, Constellation Brands, Heineken, Molson Coors. And I expect a wave of people to start dumping money in as they flee other investment vehicles due to market corrections or bad news that's going to be coming out, what have you. People are going to transition during any downturn, recession, depression, or market correction. But luckily, in bad times, sin stocks do well. Sin stocks being tobacco, alcohol, cannabis, I'm assuming, throwing that in there. At bad times, the bad stocks do well. Last week, we saw ETF investors redeemed over $8 billion. That compared to weekly average inflows of $3.5 billion in 2019. Equity funds bore the brunt of the redemptions with $7.6 billion in outflows. Most of that $7.6 billion of equity outflows came from U.S. equities. The next largest chunk came from non-U.S. developed economic markets, and then emerging market equities saw small cash inflow. So as we see people either taking profits off the top or just nervous about the market, what we do know is that sin stocks go up in times of bad. There's evidence that sin stocks still outperform the overall market during bad times, meaning that socially responsible investors pay a financial cost when avoiding these stocks because of social and ethical criteria. So-called vice stocks in the tobacco, alcohol, and cannabis industries generally are performing better than overall market, which can be seen in a report from 2010 after the housing collapse. The Vice Fund, which is invested in 3 sin sectors, plus the gaming industry, was up 10% over a 12-month period, compared to the S&P 500's 8% rise. Some individual stocks and funds in that sector fared better than the overall period. Tobacco seller Altria was up 34%. Boston Beer Company advanced 80%. And the Defense and Aerospace Fund was up 19%. Sin stocks are considered defensive and tend to remain fairly stable under difficult economic conditions, such as those that the nation has experienced during the 2009-2010 economic downturn. Demand for those products don't seem to plummet. They don't need a lot of external financing. And additionally, those companies could raise dividends and trade at below market price earnings ratios. Overall, a challenging economic situation will push more wine drinkers to enjoy quality wine and those who drink stronger spirits to buy the same liquor, but down a grade. So craft brewers such as Boston Beer, Sam Adams, and imports such as Stella Artois are poised to benefit greatly from this position. One vice industry that probably won't do too well during an economic downturn is gaming. Casino operators' revenues and profits in the past have seemed to come from hotels, restaurants, bars, and entertainment, and less on true gaming. Therefore, if or when the economy slows and people have less money to spend on restaurants, bars, and entertainment, the gaming companies will suffer. Most financial advisors aren't ready to recommend that clients jump into vice stocks yet, but some said that their clients are already having some exposure to them. Take a look at the ETFMG Alternative Harvest Index. It's up almost 50% year to date, but just prepare yourself in an economic downturn knowing that sin stocks have an inverse relationship to other stocks like the FANG Index, Facebook, Amazon, Netflix, Google. Either way, invest wisely. The number of cannabis capital raises may be slightly down so far in 2019 over the previous year, but the amount of money raised is almost double. Cannabis-related businesses have raised $5 billion year to date through 199 deals compared with $2.8 billion via 222 deals in a similar period last year. Sizes of the equity and debt raises grew over last year for both publicly traded and private companies. Two deals from the past week accounted for the bulk of the $845 million raise. San Francisco Pax Labs, a manufacturer of vaping products, closed a $20 million raise. The raise involves institutional investors new to the cannabis space, which far surpassed expectations of about $150 million in financing. Aphria, the Canadian cannabis cultivator, closed a $350 million debt raise. We haven't seen too many shareholder lawsuits yet, but I believe that with a random number like a $420 million raise set at a valuation is probably not setting a proper precedence when it comes to limiting your liability from a shareholder. I wouldn't be surprised in the future if we see a shareholder lawsuit for the random $420 million valuation. When you are asking a lot of new institutional investors or new investors, period, and you're telling them that there's a valuation and it's an arbitrary $420 million, you're basically just asking to be sued. There's nothing scientific about $420 million except a smirk from somebody who thinks it's funny. So I wouldn't doubt it that if there's a downturn in vaping, or if they get sued by the FDA, or if anything happens to that stock price and anything other than the current injection of capital that we're seeing at a speculative rate, that's really not coming behind any technical or fundamental indicators. When you just set a price at an arbitrary number, you're not really instilling a lot of long-term value. And so if or when that stock comes back down, if there's a correction, if there's a lawsuit, if the entire industry sees a downturn, there will be shareholders looking to get some of that capital back, some of their money. And if that comes in the form of a lawsuit, I'm just saying it'll happen. You can't just put an arbitrary number on that and not expect a lawsuit eventually. Other top M&A deals that closed last week include Cannabis Capital, an Alberta-based capital pool company that completed a reverse takeover as Stigma Pharmaceuticals, an Alberta-based grower and producer of CBD products. Canaccord Genuity Growth, a special purpose acquisition company, completed its merger with Columbia Care. New York-based Columbia, a vertically integrated cannabis business that operates in 14 states and territories, subsequently became the first company listed on Canada's NEO exchange with a market cap of more than $1 billion. Sproutly in Canada is going to launch an infused beverage with Moosehead. So I want to give big congratulations to Keith Dolo, the CEO of Sproutly, who's working with Moosehead, the largest fully Canadian-owned brewery. They're partnering with Sproutly Canada to make a non-alcoholic cannabis-infused beverage. Sproutly will provide its own cannabis for the joint venture from its facility in Scarborough, Ontario. According to the terms of the deal, Moosehead will provide infrastructure such as the research and development, operations, procurement, finance, and distribution, leaving Sproutly to provide the technology to make the cannabis beverage in Canada. The deal is exclusive for the Canada market, specific to hemp-derived CBD. There's an avenue in the joint venture agreement to have them expand into Europe if they choose. The name of the joint venture has not been chosen yet, but with Moosehead's 152 years of branding and marketing in their name, there's still a lot of regulatory and logistic work that remains before the product can hit shelves. That includes what can be sold, what can't, how it can be branded and marketed. On top of that, the provincial regulatory bodies in Canada still need to determine how it's going to be done, how it's going to be handled, sold, and distributed. So there's logistical issues that still need to be worked out. In the global cannabis landscape, Africa is an overlooked market. This is due to a number of factors such as the illegality of the plant across the continent and the poor economic conditions that many African countries face. Africa has the potential to become an enormous cannabis market due to the large population and favorable climate that makes growing weed easier than in neighboring Europe. A new report suggests that by 2023, the African cannabis market could reach over $7 billion. Africa has a long history of growing and consuming cannabis. In most countries on the continent, the plant is illegal, although it remains widely cultivated and consumed. The UN estimates more than 38,000 tons of cannabis are produced across Africa each year, which results in a black market worth billions. Out of 54 countries on the African continent, only 3, Lesotho, South Africa, and Zimbabwe, permit medical use, while Zambia has legislation allowing medical marijuana that has not been enacted. No African countries have clear legislation allowing recreational use. In South Africa, recreational use is illegal, but cannabis was decriminalized for private cultivation and consumption. In Egypt, recreational use is illegal but tolerated. In Morocco, the prohibition of medical and recreational use is often unenforced, although it's illegal. The first and only country in the region that allows legal cultivation is Lesotho, a landlocked mountainous country that has a favorable climate, abundant water, and fertile soil for cannabis growing. In other countries such as Ghana and Nigeria, cannabis is grown illegally, typically for export. Legalization could result in huge market and great export opportunities for businesses that pay taxes and help enrich the region. In Congo, a 100-kilogram sack of cannabis costs between $96 and $128, significantly higher than maize, which fetches $54 for the same volume. Cannabis could also create legal employment opportunities. According to the Morocco Network for Industrial Medical Use of Cannabis, the clandestine cannabis industry in the country is valued at $10 billion and employs 800,000 people. Overall, the estimates that the African cannabis market would be worth $7 billion by 2023. The bulk of this is allocated to the recreational market. The medical market is much smaller at about 800 million. Even though cannabis is mostly illegal in Africa, in the new nations where it is legal, some international companies have already established a presence. Lesotho in particular has attracted the attention of foreign investors given the possibility to cultivate cannabis for export. Last year, Supreme Cannabis Company invested $10 million in Medigrove, Lesotho, acquiring a 10% stake. Another cannabis company, Afria, went even further and formed a joint venture with South Africa-based Verve Group of companies. The biggest deal in Lesotho by a foreign company was made by Canopy Growth in May of last year. The company purchased Daddy Can Lesotho, which has a license to cultivate, manufacture, supply, hold, import, export, and transport cannabis and resin. The total value of the all-stock deal was around $28.8 million at the time. Tilray has not yet invested in cannabis businesses in the region, but it did start exporting medical cannabis products to South Africa last year. Cannabis industry has emerging markets that pop up every day. Africa is interested across all continent, and Europe is taking off. There's 5 key takeaways from a recent European cannabis symposium. Europe is fastly becoming a cornerstone in the global medical marijuana industry. Business leaders from dozens of countries descended on Copenhagen to discuss the emerging opportunities in the burgeoning market. Capital markets, partnerships, and more were on the docket Monday at the Marijuana Business Daily's inaugural European Cannabis Symposium in Denmark, one of the countries leading the medical marijuana charge. Denmark's supportive regulations have helped the country attract hundreds of millions of dollars in foreign direct investment from global leaders such as the Canadian giant Canopy Growth and Aurora Cannabis, among others. Some of the key business takeaways from the medical cannabis leaders at the symposium was that Denmark can open doors. Denmark's is supportive of medical cannabis patients and businesses across party lines. Another takeaway is not to ignore countries that are developing domestic supplies, such as Germany. Germany's bid to cultivate medical marijuana has been in the works for more than a year, which will produce only 10 to 20% of the domestic German market. That's important because always in these tenders in places like Germany, there's a few strains, whereas in Canada, you need 30 to 40 strains to service all the different patient groups. The third takeaway is to understand the supply chain. The biggest takeaway from product quality and supply chain management is being able to eliminate any issues with regulators by understanding your entire supply chain, including your manufacturer's supply chain. Another important takeaway is to make sure you understand the standards. Good manufacturing practice is simply a system for ensuring consistently produced product. Don't be discouraged by slow regulation and development. Europe's crackdown on CBD food products is happening, and it's going to take years before cannabinoid manufacturers have the certainty about adding them to foods and drinks anywhere in Europe, according to the Director of Government Affairs for the International Cannabis and Cannabinoid Institute. Standardization is still needed in Europe. Making a quality product is a challenge, but it's required in order to have the API that's always the same. Regulatory matters are not harmonized across Europe, so it's difficult for industries to get to a sustainable industry while taking care of patients. They have to get better about taking care of the patients, where there's still a lot of work to do. And with that, we're going to roll this up. This is the Talking Hedge. I'm Josh Kincaid. Don't forget to like, share, and subscribe, or don't, and I'm out.